Yeah, so I'm Lena Marx. I'm an associate in the structured finance practice with a clear specialism on trade receivables finance. And I have the pleasure of being joined by a rather eminent panel and participants from MUFG, Artis Finance, Taulia, and Demica. And maybe to kick things off, and just to give you a warning, the panel has told me they haven't had coffee yet. So keeping it hopefully alive and well after lunch, maybe if everyone could sort of introduce themselves and the organizations that they're coming from to kick things off.
I can start. My name is Dilaver Khan. I go by Dil for ease of use. I work for MUFG and I cover the supply chain finance origination in EMEA. I've been with the bank for over 6 years. Half the time was in San Francisco, so I know some of the tech players here, and the other half has been here in London. So look forward to our discussion.
Hi, I'm Shikha Kaldra. I'm in Demica's corporate origination team. Some of you may know Demica, but it's primarily a technology company specializing in receivables and payables finance. Demica platform serves about 800 multinationals via 60 banks and non-banks. Of the 60 banks, around 15 white label the technology to serve their own customers. And amongst the top trade banks are the ones white labeling. So we do see roughly half of the trade finance funding market via these partnerships. The platform is also layered with professional services and distribution services. So we also serve corporate clients directly in certain instances.
Hi, good afternoon. I'm Alistair Baxter. I'm Head of Receivables Finance at Taulia. As you may have heard, Taulia was acquired earlier on this year by SAP, so making us part of Europe's largest technology company, serving over 8 million customers across our two combined networks. Prior to crossing the fence and joining the world of technology, I spent over a decade in banking, so leverage finance, structured finance, M&A, corporate advisory, and latterly trade finance.
Thank you, Alistair. Hi, my name is Waldo. I am Chief Exec of Artis Finance. We're an NBFI working in obviously sort of trade finance. Our specialism is receivable finance, and we are a money manager. We manage capital. Most of our capital comes from the debt capital markets, which then dovetails with the equity which we put in each and every single one of our portfolios. So on the other side of Dill, but let's get the conversation started.
Then diving right in and maybe going full circle from the panel earlier that ended out with an outlook to 2023, given that we've almost reached the end of 2022 and given that it has been a rather challenging year overall, what were, in your opinion, the sort of key challenges in the trade and supply chain financing platforms that they have faced throughout the year? Maybe, Waldo, right back to you to maybe give your views on how 2022 went.
Yeah, thank you. I think all of us ended the year last year thinking 2022 is going to be a rock star year. We all had our plans. And for us, really the sort of big change in the market was the rapid rise and widening of interest rates. We had to adapt our business model. All of a sudden, we couldn't offer a cost of capital which was more competitive to the banks because the debt capital markets, the bond spreads just went wide. That obviously had to be passed on to our customers, and it's been a sort of consistent dialogue between the debt capital markets and our customers to find a sort of medium or a sort of solid ground which we could land on. I think we had a lot of projects for this year which we sort of had to delay because for most of the year it was just containing everything you've got, making sure you're on solid footing, solid ground, the rising rates, sanctions, supply chains, all of that is under management, and then basically set yourself up after a period of stabilization to then do the things you wanted to do in 22, running it out in 23. So yeah, it's been I don't think I'm the only one to say it's been a challenging year, but also a bit of a reality check and a bit of a sort of a reflection of where you are in the life cycle. And it was a good test for our well, certainly for our business model and the sustainability of it.
It's interesting. Maybe over to you, Shika, just to sort of present a view as to whether you've seen the same or have a different outlook.
Yeah, I think on the macroeconomic front, yes, all of that, we saw throughout the year, and client requests changing accordingly. Some of the things that I can mention as a technology company that we face, and I think the first point I would mention is probably faced by everyone in this room, the sales cycles in the industry are very long. Whether it's the banks we are talking to, for them it's a long-term decision to go with a platform. It takes a long time to close the cycle. Whether it's a corporate client, they're looking at their capital structure, changes to that. It does take a long time. When you get into the execution stage, I mean, for us being a relatively smaller outfit compared to the bank we are dealing with, these are large organizations with multiple stakeholders. It can be draining on resources sometimes, to work through and execute projects and do that. But we're getting better at that, dealing with each new partner that we deal with. There's also, on the tech front, the war for talent was quite intense. I think some of that might ease a little bit, but it's always very intense. We have our colleagues, tech colleagues in Poland and India and Colombia and in everywhere. The hiring is not that easy. So that was another point coming to mind. You've talked about cost of capital already, and something I feel all of these challenges at some point. You think about whether there'll be consolidation in the sector, in the fintech sector, that's serving the industry. I personally feel, and my view is that the big will get bigger. There are platforms that have grown up in very different way and have become very big. Talia's has got a phenomenal approved payables offering. C2FO has got many suppliers being onboarded. So all of the bigger fintechs, we're all very different. And that's why I think there will not be consolidation on that front. The smaller fintechs might struggle, if the marginal application of the product fit is not there. But I think there might be some consolidation, but not a lot.
Maybe staying on the topic of consolidation, Dil, is that also what you sort of see in terms of outlook, or do you have a different view on this?
Yeah, no, I think as a bank, we've had actually pretty good 2022. We can pick and choose which deals we want to be. Some leverages come back to the banks because capital's become scarce, become more expensive. So the biggest challenge we have, and I think it's the same challenge our clients have, and they've been asking us the same questions, is there are a lot of good fintechs out there, some more established, some new, some with amazing tech, some with amazing supplier onboarding teams. How do we pick and choose? So the challenge with the clients, with the banks, I think, is to pick the winners in this market. There are clear winners that are coming forward. I mean, Demica is very strong in many areas. Taulia is extremely strong as well, especially payables and dynamic discounting. So we do feel as banks, as clients, there has to be some consolidation. There cannot be 10 providers of supply chain finance that look somewhat the same. There has to be 3 or 4 that have to come forward in this environment.
You're nodding along, Alistair. I don't know whether...
Well, actually, I was going to offer maybe a slightly different perspective, not necessarily about the industry that we operate in, rather reflecting what our customers are going through. So, rather than thinking of a platform, thinking of a network and seeing all the connections and the trade flows between sellers and debtors or buyers and suppliers that exist between the SAP business network and the Taulia network combined, there's some key trends that are coming through. So I think the first one is quite clearly the world is becoming less global. And as a room of people who fund international trade, that's something that we need to take note of, and that will bring challenges and opportunities alike. Supply chains are being remapped, and this is not a broad brush, aversion to work with autocracies. We're seeing even within free trade areas a redesigning of supply chains to move away from just-in-time to just-in-case inventory management. We're seeing companies struggle with indigestion with the level of inventory there holds. I can't remember the last time I've spoken to a customer about their cash and they've not said, our inventory holding has increased considerably, this is chewing up our capital. So the way that businesses are behaving is not what we anticipated this year. We thought this was going to be the year of post-pandemic growth. We're going to see capital return. We're going to see, the good old days back again. When in actual fact, geopolitical events have dictated a very different path and actually brought to life a coming of age of supply chains that perhaps would have otherwise been 10 years away. So whilst there's definitely some tough times to go through, a looming recession, there is a silver lining in this, in that by redesigning supply chains, building security into supply chains, actually, to Dill's point, in terms of picking the winners, the companies that run their supply chains beneath them the best will be the winners.
That's interesting. And maybe touching on a point that Walder raised at the start on rising interest rates, maybe one for you, Dill. How do you see that panning out in the supply chain financing context, also in the context of supply chain financing platforms?
Yeah, no, I think the interest rate increases were meant to reduce the demand of supply chain finance. In my mind, I was thinking as interest rates go up, suppliers will pick up, sell less receivables, become more selective. However, it's been quite the opposite, exactly what Alistair is saying. I mean, the supply chain pressure is such that the capital has to move. The suppliers want to get paid in advance. They want to make sure, the buyers want to make sure they have inventory that's sitting for not just this year, but next year as well. So the demand's gone through the roof. So despite the interest rate rising environment, I mean, suppliers are picking up supply chain utilizations across all the programs are going up. New supplier onboardings are happening. And in an environment where the accounting scrutiny has gone up so much on supply chain finance, where clearly disclosure requirements have gone up, where every company is required under US GAAP to put up the end of period outstandings on all of the supply chain finance programs, it has not deterred any company out there from expanding their supply chain program. So quite the opposite. Interest rate environment has not changed the demand. I think the second part of that was, would the interest rate increases lead to defaults in the industry? We haven't seen anything like that. We feel like there's a lot of demand for short-term uncommitted capital, which is exactly where the investors want to play as well. As the rates go up, they want to ride the wave. Long-term committed capital is becoming even more scarce, so short-term uncommitted becomes even more attractive. And I think there's been a lot of lessons learned from Carillion bankruptcy. So every bank, every rating agency clearly has built within their underwriting standards basic provisions of adjusting debt for supply chain, for receivables, all of the off-balance sheet arrangements out there. So they are much better prepared to look for any warning signs of outsized payables, outsized DPO, and adjusting the debt back and making sure the leverage is appropriately envisioned there. So knock on wood, we won't have another Carillion type scenario here because the market's much better prepared and
Maybe given all the challenges, but also the upsides that you've outlined over the course of the sort of last 10 minutes, how do you see the role of fintech, also in light of the general topic that we're covering on the panel, sort of being able to tackle the challenges or really sort of build on benefits that you've already seen sort of developing over the course of the last year? And how do you see that tying in with platforms more generally? Maybe for you, want to start with, Shika?
Yeah, I think for us, partnerships really are fundamental to how we as an industry will look to address the $1.7 trillion trade funding gap. And there are a number of different ways I've seen, while at Demica, how this is done. I mean, I've talked about the bank partnerships. Over the last few years, we've witnessed a procurement supercycle from banks who are replacing their legacy systems. We want to replace Excel, and with each new partnership, I think we get closer to that mission. On the transactional side, we've seen, honestly, I feel some of the transactions may not happen if the partners don't come together. Over the summer, we saw a transaction for a factoring fintech that we were working on. The senior funding came from a bank. The mezzanine funding came from a non-bank, and we were the technology provider. So really, different industry participants coming together to address the challenges. And then finally, some of the innovative stuff that is happening, on this front in the fintech world. A financial player like MasterCard coming into supply chain finance with their Track BPS product, trying to develop the ecosystem for the long tail of suppliers as well. And we're partnering with them, and and we hope that really will increase the pie for the industry as a whole. So those are some of the things coming to mind, how we can address.
And I know Dell, MUFG partners up quite heavily in that sort of space. What do you see as the sort of challenges, but also the clear benefits? What are sort of pressure points that you see in the context of that?
Yeah, no, I think firstly, we have to acknowledge as banks that we cannot match the tech dollars and the versatility of fintech players out there. I've seen players like Taulia, for example, how their dynamic discounting platforms work, how snazzy Demica's platform looks about dragging and dropping everything everywhere. And I look at bank platforms as well. There's just tech is not really comparable. And I think the other thing that fintechs do really well is they get to the IT tech teams, they get to the procurement teams, and we are speaking to the treasury teams, which are very thin on the ground. They want to do something financially, but they are not able to drive it from top to down. Instead, IT and procurement comes and dictates that they want to work with a specific fintech because it's easy to implement, easy to integrate. It's very easy to onboard suppliers from a legal perspective, for example. So I think fintechs are here to stay. They add value, which we cannot really compete with. I think there has to be some consolidation because at the moment, everyone is a little confused beyond the top 5 or 6 winners, what the new entrants are bringing to the table. But no, I think fintechs are definitely going to ride this wave, and many of them are going to come out much stronger.
Is it also your perspective on developments, Alistair, or do you see it slightly differently?
Well, I can look at this from both sides. I guess as a reform banker, as I like to tell my technology colleagues, I totally get the value to a bank, and I've seen this work really well, where a fintech can bring a technological advantage, but also a reach into other areas that perhaps a bank footprint might not. So some of the second tier banks that perhaps don't have the structuring or the origination capability, when buddying up with the fintech that work in certain geographies or sectors, allow that reach to be extended. So as a banker, I was rewarded by deploying capital. I looked at fintechs as a way of extending the amount of capital I could put out there, and that worked really well. Now I'm on the other side of the fence, looking at it saying, well, how can I connect customers with funding? For me, it all comes down to networks, and trade is all about moving goods from one place to another. The financing is kind of supplementary to that, and the more friction there is in the financing, the harder it is to achieve it, the slower trade becomes. So what the challenge facing all fintechs, not just those with big networks, is to say, how can we make that financing embedded? How can we make it part of the trade flow and something that happens habitually, rather than something that's bolted on at the end of the fiscal year to make the balance sheet look good? And I think getting that right is going to be the key to allow banks to deploy capital and fintechs to connect up customers.
Maybe on the point of getting that right, I don't know whether there are any views on the panel as to how that can be achieved, also looking forward into 2023.
Well, sorry, what's the question? What is it?
Is it connecting capital to ultimate customers?
Look, I was listening to my fellow panelists, and I'm thinking to myself, what is a fintech? Is a fintech, is it Revolut? Is it sort of Taulia? Is it Demica? Because ultimately, these are they are different businesses, but yet they're all classified under this one word, which is called fintech, and it's quite buzzy and cool, right? But ultimately, these are technology companies that provides a service in whatever sector. And if I'm looking at sort of Taulia or specifically, you guys do e-invoicing, right? That's what you do, and so that ties into an ERP. Jolly good. You send your invoice, great, and you can do that at a massive scale. So then you can go, okay, well, great. We've got this database, so we can make that, because you're sitting with all the data. Any funder can then plug their sort of financing solution in it, because they can see the underlying data, and it becomes good from a diligence perspective. Demica, excellent reporting tool. So you can, once you have your underlying data, you can actually then sort of drag and drop and do the reporting. But you know, that's good technology. Is it? How much fin is there? So you know, to Lionel's point, I will be the controversial guy on the panel, and sort of I just don't. I'd like to sort of. Sorry, just to finish my point on the fintech, like fintech lending platforms. I remember in 2013 and 2014, Lending Club, Funding Circle, all these guys were calling themselves the latest and greatest of the fintech revolution. Even Mr. Greensill himself called himself a fintech. It's nonsense. These effectively were sort of glorified matchmaking businesses, and they effectively leveraged the peer-to-peer market. Good tech, but not so much finny. And I think from a fintech industry, in order to connect funding to technology, there needs to be a sort of a better classification of what it is these companies do. What is it that you do? If you're a good e-invoice provider, then that's a good technology company. In the same way, SAP is a really good ERP system, really good, right? But they don't call themselves a fintech. And I think by sort of classifying it, and it's also easier then for sort of bankers and funders alike to sort of then say, okay, well, fine, we can partner with a technology company that's going to provide a specific service, and we have to diligence that. I think that will bridge this gap a lot closer if we just are comfortable defining who we are and not trying to chase valuation on a buzzword.
Maybe I take that one. So I disagree. The techs are not fintechs, which we're employing. And I would go back to my point. Some of the transactions that we work on would not happen if we don't bring the players together and if we don't support the fin part the way we do. So I would just rest it there.
But that's an advisory piece that you offer.
So yeah, we got
that's an advisor then. So you've got a technology play within an advisory leg to it that knows the key contacts in banks and funders that can leverage your technology. So
and
it's
no
not
structuring.
Okay.
I think the reality is though that perhaps in years gone past there was a fintech premium. You would get a better multiple branding yourself as a fintech versus a bank or a brokerage, which tends to be net book value. Or even a tech company. But the reality is that premium has gone. In fact, in some cases, it's even a discount because investors have got wise to the fact that there is a drag on capital. Yeah. And actually, branding yourself as a tech company, as SAP does, is probably better for multiples. Not that you should look at the SAP stock price right now.
One, I think probably I could bring up, a transaction that we saw last year where, this was a company that helps, this is a US-based fintech platform again, where the company helps clients to offer longer payment terms or payment terms to suppliers they wouldn't otherwise. And, they were a private equity-backed company. They had a traditional ABL facility in place, but, working together with us, there was a securitization transaction structured alongside an invoice discounting for certain receivables that can't go into the securitization transaction. And that really just lightened up the balance sheet to increase their valuation, which from a financial company, they became a fintech just because the balance sheet became lighter. So, as I was saying, it's for us, it's a conscious choice. We do not want to principal because we work with so many funding partners. Yeah. We do not want to be in conflict with them. Yeah. But I don't think that does not then qualify us as a fintech.
Yeah, I think I also agree. I think it definitely is more tech before it is fin, but you need to have a fundable structure so that the investors can come in. And for that, you need to have the structuring and the financial background or enough people in the organization, probably 30 or 40% of the people, not majority, who do understand finance and can get the deal funded. So I think it is a combination, but I agree. I think tech is where they lead with.
Look at that. Yeah, I would akin it to say IBM. IBM is a tech company and they have a great advisory company. So they have advisory consultancy. So if you want to have I'm not even sure what IBM sells these days, but I know they've got a consultancy side of it. So if you want to have IBM, you engage with the consultants, and they give you the structuring package of how your tech should work. But you don't hear IBM call themselves McKinsey or a consultancy business. They are a tech company. So I take the premise that there's a at its core, so Thalia and Demica are tech companies, but they do have a sort of consultancy advisory piece, right? But that doesn't make them a fintech. It's a tech company with an advisory component, and that just we all know what we're talking about,
Then maybe agreeing to agree that we interpret fintech slightly differently and classify them slightly differently. Maybe one point to sort of focus on what would be interesting to hear from the panel is the sort of financing optionality that you see in the market and how these play out on these financing platforms. Maybe sort of that builds on a point, Alistair, you raised before. I don't know whether you want to add anything to that question.
Yeah, so I guess, my kind of observation on this is that diversity of funding is absolutely paramount. So we're kind of, hearing more and more from customers that achieving liquidity in tough times is harder, and being able to leverage assets such as receivables that they have today is one way they want to get out from that. But I guess using technology to access that liquidity is really the kind of nugget that everyone's chasing after. And I guess that's something that we're all looking at in the round, saying how can we find better and faster ways of doing that as a fintech.
Look, I mean, I'll address the answer a little bit differently. I'm going to quickly talk about where the capital sources are coming from. So you've got my colleague over there, Dill, which is a bank that's got sort of a lot of deposit holder money, and of course he raises money in debt capital markets for his own balance sheet, which makes it very attractive for his customers because he can offer a rate which I simply cannot. For the likes of us, we do see much more participation on sort of more capital market securities that your fixed income investor is used to. So deals that are typically structured that's akin to an ABS or a CLO. A series there may not be several tranches in it, but at least a single unitranche, of senior debt. And we're seeing a lot of participation from the pension fund world, insurance companies that's coming into this asset class because they see it as an attractive asset class on the receivable side, which is sort of decorrelated from your mainstream, sectors such as anything else. So that is a very positive sign. And then obviously technology plays a extremely nice role in it, or good role in it, because you can sort of drill down into the underlying assets which it is you're financing, right? Which is then great. It means investors then tick the box from a regulatory perspective because they can actually see exactly what it is they're providing leverage into. I think you'll see more of this. I'll think you'll see more quasi-securitization plays in the industry, especially for your sort of mid to large size corporates that will then look to either move to an off-balance sheet solution, so either on the receivable side or the inventory monetization side. And again, that'll be a really good place for tech companies to come in and provide an elegant reporting tool, processing tool, because typically these facilities work on eligibility criteria, etc. And tech companies are really good. You plug in your ECs and then it runs through the model, and every day you've got your purchase logic that runs, and then you really have a homogeneous asset pool which these investors are liking to invest in. So long story short, I think there's a much more interest in the institutional capital side. I think the market has moved away from this P2P lending stuff and much more institutional, much more sophisticated, and that's collaborating with banks in particular and technology companies.
And that seems to marry up quite well with what Shika was saying in terms of the transaction that you saw last year in the US, where you had quite varied sources of financing. Would you sort of echo all those views on that? Or?
Yeah, absolutely. I mean, different players coming together and We've also seen the surge, I mean, Walt was referring to that, but the surge in non-bank funders entering the trade finance market. And to be, to give credit, they're able to do things, with a lot of flexibility. They're probably more flexible in terms of their criteria, in terms of the structures, the bespoke structures they're able to put in place. And they can also be quite fast sometimes. I mean, I remember, Apollo colleagues mentioning, they were provided money to herds $4 billion in 7 days. So, it doesn't happen every day, but, they can, there's a lot of new stuff happening because a lot of interesting players are coming and bringing their offerings and customizing them for the needs of the customers.
I think we definitely see the institutional investors come through in this market, receivables, payables, short term. But I think one thing I may disagree with is they actually, once they understand the structure, they're very quick to get there, but they're not very flexible on structures. So they would always want a firm payment obligation. They want a rated entity. They don't understand the nuances of split risk between multiple entities, for example. So as you go into kind of downstream from supply chain to, let's say, inventory, I think those are going to be difficult assets for that market. You still need the bank market that can understand split risk and underwrite that and fund it, at least in the near term. But maybe technology can help there. Maybe they can understand exactly how the payment obligation is flowing. But they, in our experience, they don't have the patience or the flexibility to understand the underlying structure.
Yeah, because they're looking to invest in an ABS or a CLO, right? And the legal framework has got to be exactly the same. So, yeah, totally agree with that.
And probably one thing to add there, we, as players out, providing support to the transaction, we do wonder. I mean, banks tend to be very relationship oriented. Whether the trade finance players, how much of relationship angle, I guess they are here for the long run, but they would only take slivers of the services the customer needs. I mean, the bank is providing the full transaction banking suite here. So the trade finance players come in for slivers, even if they are here for the longer term relationship.
Interesting. And maybe moving on to a completely different topic and sort of ending the panel on the same topic that the last one ended on, which is ESG. And you might disagree with the views offered on that panel. How do you see ESG criteria sort of being tied into trade financing platforms? I think on the previous panel, the sort of view was actually, it's very much top down, and there's not that much of a drive within sort of trade financing platforms and so on to set that up themselves. It mostly comes through banks imposing criteria in terms of ESG and sort of driving that market forward. Maybe one for you, Alistair.
So I'm going to go deep on this one.
I'm ready.
It's now impossible to pick up a company's annual report and not see the letters ESG somewhere near page 1. It's something that has been around for a while, and when you're looking at specific single entities, it is quite well known. Green bonds have been around for 5-10 years nearly, so it's something that is quite well known and quite well understood. But that's just the tip of the iceberg because, first of all, E is very different to S, is very different to G. And depending on who you are, the geography you're in, and the sector you're in, it means different things to you. But moreover, the companies, particularly at the top of supply chains, now have this almost fiduciary duty to ensure that everything that sits beneath them adheres to their standards. It's all fine and well saying I'm a green company, but if all of your input energy comes from a coal-fired power station, you're not really taking into account the full supply chain or value chain that sits behind what you're doing. So whilst companies can talk about their own green credentials, what we're going to see more and what we're seeing through investor activism is not just how they're behaving, but actually how they're shaping the full network of supply chain above them and below them. And that, I think, is going to be big. My forward-looking statement, if it's a dangerous thing to do, is that 2023 will be the year that ESG goes big. And we're going to hear companies like EcoVadis everywhere because that's going to be, in some ways, more important than a Moody's or an S&P rating.
Anyone else on the panel share that view, Shika?
I'll probably put some controversy in there. I think ESG is incredibly important and it will only grow. What I feel at this time, there's a lot of proof of concept, but we are still very far away from billions of dollars reaching the ground for ESG. There's a lot of talk, but actual transactions, I mean, in the previous panel I was asking, how much of it, we're able to, there's a lack of credible data. There's a lot of measurement initiatives. I mean, you mentioned EcoVadis, Coriolis is doing stuff. So there's a lot of initiatives and there's a lot of work being done to achieve that data and measurement that we need for ESG transactions, but we're still a bit of a distance away from that. Again, I see some beautiful partnerships happening in this area, a lot of banks doing stuff, multilaterals coming in and supporting, the supply chains there. But yes, we have some distance to go there.
Yeah, I agree with Alistair, but I also agree with you, Shika. Not a single discussion on supply chain happens without ESG at the moment, whether it's existing programs or new programs being thought of. And everyone's motivated, the buyer, the bank, to get this done. But in terms of actual proof that this works, will suppliers change their behavior? Will they join supply chain finance programs and improve their ESG ratings and the KPIs? I mean, it's far from it. I mean, in this environment where supply chain pressure is front and center, where you want to make sure you don't offend the supplier at all, you're going to go ask the supplier for extension of payment terms, and then you're also going to ask them to improve the ESG score. I mean, you can only pick your battles. So I feel like the buyers can talk about this a lot, but when it comes to actually implementation, asking the suppliers, holding their feet to the fire, there isn't a lot of will at the moment in this environment.
I'll probably add something as a smaller company when we deal, and I'm talking as a supplier now. I supply to larger companies, the banks and big corporations. Often we see an issue, as a small company, I'm asked to sign up to their code of conduct, their ESG policy. Our legal and our colleagues, and we're looking, can we really sign up to this? Can we do this? So, there are a whole host of issues that come when you start to impose stuff in the supply chain.
I think from us in the NBFI space, I think it's important to sort of separate those three letters, right? So certainly for us as an NBFI, and I'm sure for Dill as a banker, the governance side for all corporates that you get involved in is critical, right? You have to get good corporate governance across all the corporates. So that means, stuff like, due authorization on payments, for example. So the governance side, definitely, we all accept, we do just from a credit risk perspective. On the social side, equal opportunities on the employment side and things like that, very much a core feature. I think from the NBFI side, we're more focused on the governance side than the S side. However, it does features in our underlying analysis when we look at opportunity. Now, talking about the environmental side, it doesn't really feature in global supply chains. That if you're financing a cross-border receivable, ultimately that vessel is powered by gas oil, it's loaded from a bunker fuel outside the port of Rotterdam. No one really asks a question, well, how is that E? And the reality is, in terms of the larger transactions which we're looking at, and Dill could probably attest to this, is these are your big energy plays, right? And we haven't really, as a society, transitioned out of the carbon, hydrocarbonates into renewables at scale. Even if reflecting to the big renewables projects in the UK, those are not really that interesting anymore because of the government's decision not to sort of underwrite the underlying wind farm projects and solar projects. So your credit risk profile has substantially changed. And again, looking at your energy transition, the reality is that crude and diesel and refined products are still being sold and traded, and the world still functions on it, right? And until we've sort of really made progress, forgive me, in our energy transition, that's when the E side of that equation becomes a lot more interesting for all of us to get our teeth stuck into.
Great. I think that almost takes us to time and possibly questions from the audience, if anyone has any questions.
Nobody wants to debate what a fintech is?
I've got a question for Dill, if it's okay. You triggered a question. Dill, you mentioned something about the cost of finance and your availability for credit lines. Have you in this, which is now, I think we're not through the cycle yet, but we sort of at the top of interest rate rises. Has the regulator sort of done stress testing on your trade assets across the bank to sort of try and see where it's landed? Have you seen I don't want to say on your book uptick in defaults, etc., but has the regulator put any focus on it to try and test it in the same way that we had in 2008 on the mortgage market and bank balance sheets?
Yeah, I think the challenge there
Sorry.
is each bank has trade finance across so many different products that it's very difficult to measure. I think generally the capital is becoming more expensive. I think that's something we discussed when we were preparing for this. There's a Basel IV accord that's coming through. That's coming in with floors on RWAs. So trade finance funding is only going to become more expensive over the next few years because it doesn't discriminate between a 3-month loan and a 3-year loan. But from a regulatory perspective, they haven't really come and really scrutinized individual books at the moment because I think the reality is the books are divided amongst multiple product areas and different guises.
Okay.
Okay. If there are no further questions, I think that just allows us with 1 minute to spare.
Lena, I can ask a question to Alistair probably.
Have you guys met before?
Sorry?
Have you guys met before?
No, I think I met Alistair first time today, but you guys do payables really well. Dynamic discounting is a payables product, and it, in a free, in a very cheap cash environment, it made a lot of sense. Now cash has different value. So how do you think that will pan out for dynamic discounting?
So, yeah, really good point. You know what, I would take it back a further step. It kind of links into my point about financing being embedded. So, no company is only a supplier and no company is only a buyer. The reality is companies will exist in different points of supply chains depending on whose supply chain they're part of. And whether it's a payables solution top down, a receivables solution bottom up, they want a fast and effective way to capital or liquidity to support the underlying trade. And that's I guess the key here. And it could well be a case of that, redeploying treasury cash was a lucrative game 2 or 3 years ago when bank yields were low and money was cheap. Perhaps the marginal gains of that have dropped off. That will probably just see an uptick in SCF because bank liquidity will replace treasury liquidity. But then likewise, with changes in the way that disclosure, as Dill touched on earlier, obviously FASB's come out, IASB's not too far behind. That might again change the way that corporates look at supporting their supply chain, whether actually flipping to a receivable solution that uses technology to support it through a network is something that will be more appealing to them. But fundamentally, it's just a mechanism to allow capital to land where it's required. So you're right, it will change, but I guess the key thing for all of us is making sure that capital hits the right spot at the right time.
I think that's it, and just
Thank
a
you.
minute to spare. Thank you very much,
Yeah,
everyone.
thank you, everyone.